Hey guys, this is Terry with Futures.io, and it's my pleasure to welcome back Peter Davies of Jigsaw Trading for today's webinar, Successfully Trading the Open. During the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. You can follow us on Twitter, Facebook, and YouTube at Futures.io. And without further delay, I'll hand it over to Pete.
Okay, thank you, Terry. Let's just make sure my screen is up. 1 second. Okay.
All right, looks good.
You got it there?
Yes.
Okay, so let me just skip through the disclaimer. Right, we are going to talk about trading today, and we are going to talk about specific entries and exits. What I would say, and I will advise you through this webinar, is to practice this first if you're going to have a look at it. We will go into the details of how you can do that. But also remember that when anybody talks about trading, they're always talking about it from their own risk profile perspective. So just bear that in mind as well as I talk about the trade. So today, we're going to discuss trading the open. Now by that I don't mean the opening range, but the actual open itself, so not the first 30 minutes or 90 minutes, but actually the first few minutes of trade after the market opens. In some cases we'll be looking at taking trades within the first couple of minutes after the market opening. Now, as with any trading opportunity, there's more than one way to approach this in terms of trade management, and we are going to discuss that too. But we're looking at an opportunity that's available often, sometimes within seconds of the open. Now, there's a couple of ways that you could look at the information here today. Now, one of the ways you could look at it is that I'm going to give you a setup, something you can take away and just copy. And that's pretty common in the trading education world. We all know this is a very cozy situation we're in. People want to buy setups and people want to sell setups. And it's also very common to want to watch somebody trade those setups live so they can see how it's done. But if you have a look at how prop firms operate, they don't really give their trainee traders setups. They teach them how the markets behave. They give them guidance, but they don't give them a precise set of rules to get in and out. Now, in most prop firms I've spoken to, they also don't let the trainees watch the experienced guys trade. And that's partly because the experienced guys are there to make money and they don't want to be annoyed by the new traders, but also because there's a high turnover of trainees that never really make it. So the experienced guys would spend a lot of time advising people that really wouldn't make it anyway. Now, once you're making a little bit of money in a prop firm, you're going to find the experienced people become more accessible. So with a prop firm, you're given a lot of guidance to help you figure it out yourself. So the concept of buying a setup and watching somebody trade before you can do it, they're very unique to the retail trading world, and I don't think either of them are required to turn you into a trader. In fact, I think they're trying to get setups from other people could be counterproductive because it's not really learning how the market works. So with that in mind, I would like to propose that you consider this information today in kind of in two parts. So part one is market behavior. So I'm going to show you some market behavior that you can observe at the open. Now, nobody showed me this behavior. I was simply watching this every day and I just couldn't help but notice what was happening. And then the second part, we're going to look at how I personally approach trading that behavior. Now, it is very possible that somebody watching this today will look at the behavior that I'm looking at and figure out a better way to trade it, and that's absolutely fine by me. But if we can separate the behavior we're looking at from the actual trading part, then you're going to benefit in another way, because you'll be able to trade with a little bit more confidence, because that confidence when you're in a trade really comes from knowing, first of all, that trade is worth taking, and then second of all, knowing whether your trade is actually working or not. So if you trade this setup tomorrow and you lose money, the chances are you're going to lose confidence and then you just go and look for another setup. On the other hand, if you watch this behavior at the open for the next 2 or 3 weeks and you became confident that yes, you know, what he said there is true, the market really is behaving like that, then you're not going to be shaken by a couple of losers. You might think, well, you know, the market did what I expected, but I lost money. And then what you'd find is you'd be in a position where you'd actually be trying to figure out why you didn't trade that behavior well. So that's the difference between someone that's just setup oriented, give me the setup, I don't want to know about the markets, I just want the setup, I can rinse and repeat, and some of this behavior oriented that's saying, okay, show me how it behaves, I can see it behaving like that, then I have to figure out how to make money from it. Now the other piece of advice, before we go into the detail, I'm going to say, do not take my word for anything you see today. So if, like me, you're watching the markets at the open anyway, you can just look out for what we're going to discuss today and see for yourself. Okay, so don't be in a hurry to trade it. Now, conventional trading wisdom tells us to avoid trading in the first few minutes. Now, I used to certainly have that belief myself, and that's not because there was some smart individual that said, Pete, don't trade the open, but it was just because I'd seen this written, I'd heard it spoken so many times, I just never questioned it. So I was actually watching the behavior I'm going to show you today for at least 6 months before it actually occurred to me that I could actually trade it, because so strong was my belief that trading the open was bad. I literally was watching an opportunity and I just wouldn't take it. I just couldn't bring myself to take it. And so it's worth having to think about why people are actually advising us not to trade for the first 15 minutes or to let the market show its hand before placing a trade. And the most common reasons we hear are, first, that people say it's too volatile. And I would agree, it is volatile. It's going to swing one way and then the other very quickly. But that doesn't mean it's too volatile to trade. It's just a behavior. Another reason that people say there's no high or low range for the day yet, and maybe the previous day's range extremes may be too far off too, so we don't have any reference points to play off. Kind of understand that concept, but we're actually going to look at reference points we can play off in this webinar. Now, for index futures, an interesting thing, institutional equity trading is just starting for the day, and the stocks and the futures do need to kind of realign. So you find a day with the S&P futures open 50 points down, that is actually a valid point. But most of the time, that kind of alignment to the stocks and the futures really doesn't affect this setup. And one article I read, and you can probably find this if you look on Google, Trading the Open, that says that trading in the first 5 minutes is nothing but gambling. And there's a lot of reasons apart from that out there too. And the advice to not trade those first minutes, it's not really terrible advice, it's just really generic advice. You know, don't trade the open. It's just a wide sweeping statement that appears to apply to all markets and every day, as if it's written in law. Yeah, as we're going to see, there is opportunity there. Now, I will say that not all opens are equal, and I would also say, why would they be? Not all markets open in the same way, and of course, why would they? So today, we're going to look at behavior that occurs on more days than it doesn't on the markets I trade. Behavior that is most likely caused by people positioning into the open, although I've got to admit I haven't spoken to them, so that is an assumption that I'm making. Now, before we consider the opportunity itself, I'm not just teasing you here, I'm going to tell you, we have to consider what an open is. So many markets now are open almost 24 hours a day. If we look at the CME futures, the index futures products open at 5 p.m. Central, and anyone that's looked at the index futures at 5 p.m. Central will know the markets are really quiet then. So for those that work office hours in the US, it would be an ideal time to trade, you know, when you get home from work in the evening, but there's just not much institutional or even retail trading going on. It's kind of the lull between the close of the US banks and the open of the Asian banks. So even though the market opens at 5 p.m., that's not what people generally refer to as the open. So we get the US futures markets remaining quiet until the Asian banks and prop shops open. So we do have an Asian open, and most US markets still are fairly quiet during the Asian morning session. US index futures are quiet, but some markets do have decent range and volume at those times. Crude oil, Japanese yen futures, mini Nikkei, are examples of markets that are more actively traded in the Asian session for obvious reasons. And then later in the day we get the European traders joining in. We get the Eurex in Frankfurt open, and that's when the DAX, Eurostoxx 50 and the Bund futures start trading. And most of the time the first hour of the Eurex trading is pretty quiet. There are exceptions to that, but for those of you that trade German markets, you probably know that if nothing happens in the first 5-10 minutes, best bet is to go and have a coffee and come back 50 minutes later, because that's when the London markets open, and that's when we see that really big pickup in volume. So the volume from London is massive. We have Forex, crude oil, Euro futures, interest rate futures, all see good volume and decent ranges. Now, the stock index futures in Europe generally aren't as volatile as the ones in the US. Of course, the DAX is the exception to that, but arbitrage does keep them in line most of the time. So we have higher volumes and wider ranges once London opens in comparison to the Asian session. And then we've got the US Open. So what exactly is the US Open? Well, for those of us trading index futures, some of us used to call that day session, the US day session, the pit session, in reference to the times the CME trading floors opened. Now that most of the trading floors are closed, it kind of really doesn't make sense to call it the pit session anymore. So for US index futures traders, the key opening time is when the underlying US stock exchange is open, which is 9:30 Eastern. And of course there is pre-market stock trading, which is generally light, but at 9:30 AM stock market opens and all the volume in the correspondent futures markets increases dramatically. So we have more people, more computers coming in to play those markets. So the open is, in theory, when the underlying market opens and we see an increase in volume. So this could be a stock market like the index futures, or it could be a trading floor, you know, if we look at grains, meats, energies, that kind of thing. But we know the trading floors are disappearing, right? They haven't disappeared for all markets yet, but for a long time the volume in the pits has really been overshadowed by electronic trading. So with trading floors, you know, showing a lot of the time less than 1% of trade in most markets. So this concept of having a large underlying market or having a trading floor, an open equal trading floor, it's a bit misleading. So for now, I think it's fair to say that in many markets, it's more tradition than any underlying market that causes the volume to increase at the open time. And it's just accepted that, you know, the bulk of US institutional traders come in and start trading at that particular time. So I think it's more a matter of basically that people need to start work at some point in time. And so those open times, which are mostly traditional, they're still followed, and that could change over the coming years. Opening times could eventually become irrelevant for markets that don't have a compelling and large underlying cash market, the way the stock index futures do. So, you know, that's something we're going to have to keep our eye on. But basically, it's the US day session that most people consider to be the open. Even so, whilst we might consider that to be the open, many of these markets are open almost 24 hours a day, so what they haven't really done is just opened, they were already open. So even those traders that are watching the opening range on index futures, the first 30 minutes from 9:30 AM to 10 AM Eastern Time, they're actually watching the 30 minutes of action of a market that opened 5 PM the previous day. And this, of course, is one of the keys to trading the open. It's not really the open, but it is a time when a significant amount of additional volume comes into the market, and with that comes specific behavior that we can try to exploit. So you have fresh players for the day that need to do business, they've got position to put on, and we've got some already theirs for the day. And there's information that we're going to use from the Asian and European trading to help us make decisions as those US traders come online. Now, in most futures markets, probably all of them, the US leads in volume, but a lot of the time there's significant volume traded into the US Open, and quite often right before the US Open, and we think probably that's mostly European traders. I've no doubt it's a lot of US traders doing this as well. And it's this volume of trading, or rather the positions and liquidity of those traders into the US Open, that give us the opportunity. So the first thing we're going to look for are areas where a lot of traders are positioned, and quite often right before the US Open, and we think probably that's mostly European traders. I've no doubt it's a lot of US traders doing this as well. And it's this volume of trading, or rather the positions and liquidity of those traders into the US Open, that give us the opportunity. So the first thing we're going to look for are areas where a lot of traders are as you get close to the open. And the best way to look at this is by going through a few examples. So first, let's walk through the behavior we're looking to exploit. Then we'll look at how to trade it, or how we might want to trade it. So this is February 13th this year. As you know, market had been really slow at the start of this year, still is, and that kind of makes it more important to look for early trades, because quite often that initial move, that initial push off the open is all you're going to get before the market reverts back to a range. So we're not actually going to focus on the charts much. In fact, I'd say that if you're trading chart based, that's probably why you're not seeing these trades, because you're actually looking at information that's not really going to help you for trading the open. So let's just look at the key things we're going to look at first. First of all, the time. It's 1 second before the open. Second, we're going to look at this column here. So this is a volume profile. Lots and lots of trading tools have got a volume profile. Some people use a volume profile on a chart. I prefer for this setup to use a volume profile like this. I want to see the numbers. I want to kind of know how many contracts traded there, so I can see where the steps are. And what we can see, we've got significantly more volume traded from 17.25 to 23.18. And we've also got higher volume below us from 23.15 to 23.15.50. And we're actually sitting at a potential high volume node developing, or high volume area developing, at 23.18.75.2. But whilst there is almost 9,000 contracts traded at 18.75, it's really not part of a larger high volume area. So, you know, this area here, if you look, compare it to the two areas, it's just not as significant. So we're going to kind of ignore that one. Now this volume represents actual positions, right? It's a place we can say a lot of trading took place. Now, of course, that doesn't mean that all the people that traded in that area are still positioned right now, but relatively speaking, there are going to be more positions in these areas because there's more volume. So what we can also assume is that the closer these positions are to the current price, the more likely the traders there are still in the market, that they haven't been stopped out. So if we imagine a trader that went short at 13.25, they're a lot less likely to be in the market now we're trading at 23.19. So if we get back to 13.25, we can't really and reasonably expect the traders there to react. They're probably already washed out. Now what we've got here, we're looking at, on these columns, if you don't know the trading dome, the inner blue column and inner red column, that's just the market depth. People with limit orders waiting for somebody to come and trade with them. There's not a lot of significant depth on there. It's pretty even, apart from this up here at 2321. Doesn't mean there's no liquidity around here. It just means that traders aren't showing their hand. So what we're going to see is that we're going to make some presumptions about where the liquidity actually resides based on where the most trades occurred. Because this early in the day, seeing these exceptional amounts of depth is quite rare. So as you're going to see, high liquidity is not a factor in these trades, so people just generally, they don't want to show their hands. Now, for those of you who don't understand this term liquidity, just means limit orders, passive orders that are waiting for people to come and trade with them, limit orders, bids and offers. Now what you can see, we've got these X's here, and these X's are just my way to kind of note down before the open where the high volume is, because when the market opens, I like to clear down the volume profile. So we're just looking at the price and volume since the open. So the X's just give us a guide to where the volume was from overnight. So what we can see, we opened at 23.19, moved down to 23.18.25. We haven't traded there, but that's where the bid is, and that is just one tick above the high volume node. Now just for information, just so that you understand what I'm talking about, these inner columns here show us the number of contracts traded last time round. So we can see that in terms of, these are the sell market orders that trade into the bids, buy market orders that trade into offers. We can see the market's fairly balanced. We've moved down and nobody's traded into 23.18.25 yet. We're a tick above the high volume area. In other words, the market's moved down to this high volume area for a test to see if there's any interest. Okay, a second. Just give me 1 second. Okay. So what we can see, market bounced up to 23.2050. And excuse me, I just got my notes in the wrong order. Okay, market bounced up to 23.2050, and then it moved back down to 23.1825. Okay, now in terms of the behavior that we're looking at here, we can see the market bounced up off that area, but what happens if we look at the previous slide is that first bounce we're actually hitting the low there at 9:30 and 15 seconds. So we do get an initial reaction, and it goes up to 2050 and then comes down again. So what you're going to see quite often is that the market is going to open close to the high volume node right at the open, and then that initial reaction that you get is going to be very, very quick. Okay, so what you're going to find is there's often, with these early trades, you're going to see the market go to your level. It's going to move away very quickly, and you're not going to get a chance to hit it. And sometimes that will be it. You'll have missed the move. The market will move straight away. But quite often, as in this case, it's going to come back down to the area and hit it again. So in this case, we're actually 4.5 minutes after the open. We've come back down to test the area. We've got a little bit more time to make a decision. Okay, so what you're going to find with these trades, okay, it's where we got to. What you're going to find with these trades is sometimes you're going to be right about the trade, but you're not going to be able to make any money purely because there's no time to make that money. Okay. Now, if we look at another opportunity, what we're going to look at now is a way to trade that behavior. So just to summarize what we talked about, market's going to build high volume into the open, okay, and those high volume nodes are going to get tested, and the extremes of those high volume nodes are reaction points that we're then going to attempt to trade. So let's look at how we're going to actually take those trades in action. So what we've got here is 14th of February, the next day, and we can see I've got X's at 25, 75, 26 and 24, 24, 25. And what's interesting about this day is I usually come and put these X's in at around about 9 o'clock, 9:15, something like that. And in this case, I actually had two separate areas of high volume, 2 ticks each. Okay, so I'll put the X's there. But as we moved into the open, what happened is we actually filled in the area in between. So what happened is we traded between those two high volume areas and kind of filled it in. Now you can see that the volume we have at 25, 75 and 26, 11,000, 10,000, it is actually quite a lot more than the volume in between. But in this case, I would consider this to be just one larger high volume area. So you really want to see a big difference in the volume between your high volume area and the areas around it. So in this case, I originally thought I'd got 2 high volume areas, which means I'd potentially be looking to short 24, 25, 24, also be looking to short 23, 25, 75. But in this case, I'm just going to take it as one area, just looking at the extreme. So we're 2 seconds before the open here. And let's just have a look at where we got to. So again, we can see that we opened just 1 tick below the high volume node. Now I don't really understand why this happens as often as it does. A lot of the time it's actually building a high volume node right into the open, but a lot of time you get a high volume node and the market just moves back to it and opens right there. Now again, what you're going to find is quite often that you don't really get a chance to open. So if you get into the trade, so if you look at the time here, it's 9:31 and 30 seconds. It's a minute and a half into the open, and we've already opened at 23.75, moved down to 22.50, and we're back at the open price again. So what's happened is right from the open, we moved down 5 ticks, and now we're back to the open price again. And again, that move down off the open, for me, I've seen it hundreds of times. Open at the extreme of volume and just immediately within seconds it moves away. I've never found a way to exploit that move, okay, because I'm still trying to look for some confirmation before I get into a trade, and obviously with a move happening within seconds it's almost impossible to see any confirmation. So I've not found a way to trade that, but you can keep an eye on that and maybe you'll see something I don't. Now the other thing I'll talk about is the market depth. You know, we know there's a lot of heat maps out there on the market right now, and what I'm going to say is the market depth, you know, this is our heat map. The market depth is really not going to help you in these trades. Okay, so we can see close to the market there's not really any significant market depth. There's this at 2175, we've got 1500 here, but there's not really any significant market depth. I think partly the reason is because it's so early, I don't think the market makers are engaging in the same way. But basically what we're looking for here, we're not going to get much of a clue in the market depth. We really want to see just the market starting to move away from our area. Okay, so what we can see now, we're back at the open. Let's go to the next trade. Okay, we didn't actually have an entry on that trade. So if we just look at the confirmation that we could get, if we look at the Dow, we can see the Dow's going up. The NYSE ticks down, which is good for a short trade. We have just opened though, it's only a minute's worth of data. The Dow's up, the NASDAQ has come down, but it's also ticking up. We've got a ton of buy market orders hitting the market. You can see on the current trades here, it's very biased to the buy side. So overall, we really have some momentum, we really have some buying against us. So with that in mind, it's not a good idea to take the trade. And the market does march up. And what we can see, the market actually marches up to 26.25, which is actually one tick above our high volume area, upper high volume area, and we see 52 contracts trade into that, so not a great deal of trade. And we can see a lot of 52 contracts there. We can see a lot of trade at 25.75 and 26. So what that's telling us, we've gone up to 52, come back down, and now we're seeing a lot of trade. So effectively, we've actually got an iceberg order on both sides here. So we can see that 2,700 contracts were added at 25.75, 909 contracts added at 23.26, and that's just that high volume area. So for this trade right now, I do have the Dow and the NASDAQ marching up. I've got some more sellers that I can see, but I've also got this iceberg here. So I don't want to short this just because of this, this area here. I want to short it if the bids break, because obviously we've got both sides here stepping up and absorbing the buying and the selling, and one side's going to lose out. So I've got a volume stop order here, which means if this bid goes down to 200 contracts or less, it's actually going to sweep me into a trade. So what I'm doing is I'm saying, okay, I'm at the top of a high volume area. I can see a lot of trade occurring. Might be holding the market. If the bids start to break, I'm going to get into trade, and that's exactly what we did. Now, what happened, if you see, we had the volume stop order at 25.75, actually got in at 25.50, so we slipped a tick on the entry, but we're in the market. Now, as you can see, we've got plenty of sellers now. We do have a stop just the other side of this high volume area, so that makes sense to me because we had all this volume trade in this area. If it starts moving up aggressively now, we know that the traders in that area are going to get stopped out. Okay, so there's going to be stops there. We want the buyers to stop out and for the market to move down, but if it starts moving aggressively up, we should get out of that trade. Now the good thing about having volume above us like that, it's a bit of an added bonus because, you know, markets tend to move slowly through higher volume areas. So an area we traded a lot of volume before, we tend to trade a lot of volume again. So any move against us should take a bit of time. So in this case, if we saw a lot of buyers come in on the tape and we saw the Dow and the NASDAQ continue to pop, we'd have a good chance of being able to get out of the market before we actually hit this stop. And this is as low as we got. So it's now 10:07. We've been in this trade for 30 minutes since 9:37. As I said, the S&P was very slow during February, and it continues to be slow this month. So we've often started the day with an initial move, then we've moved sideways in a very narrow range, and that's lasted sometimes for hours, sometimes the rest of the day. The fact that this has only moved 4.5 points down, and that's pretty much all we got from the trade, it's not really a reflection of the way this trade works out. It doesn't represent the maximum potential for this trade. It just represents a lack of volatility in February when I took the screenshots. Now, it's a little later in the day, so it's at 10 o'clock, and now we can see, we can see on the bids and offers, we can see there's more variance in the bids and offers. You can see the bids and offers have gone down to 600-700, and then we've got some areas of high volume on the bids, and we can see it on the heat map as well. So what happens is you'll quite often not see decent bids and offers as you get into the trade because it's early and they're really not around. But as you get through the trade later on, we can see the players come in with liquidity. So even though you're not looking for high liquidity when you enter the trade, you might be looking at it when you exit the trade later in the day. So anyway, this ends up being the end of the move because as the bidders here, we got bidders here 23.21, 23.20.75, 1,800 contracts at each price. Basically, we're seeing some bidders absorb the selling. It's a range-bound market anyway. We knew in February it was range-bound. We're not expecting it to take much to turn this market around. So for the narrow days we had in February, this is actually a decent trade. Bank some profits. We don't have to worry too much about watching the market chop around for hours. Okay, so that's Monday the 13th and Tuesday the 14th to do. Let's look at the Friday before, which is the 10th. Using 3 consecutive trading days here so that people don't say, well, you're just cherry picking. But this one is a little bit uglier. So we have volume from 650 to 725, and we're set to open above that high volume node. We just have the one high volume area, so we just have that area to look at. Now again, like the other slide, we do have some volume building where we are, 8 to 875, but this is right before the market, and it hasn't had a chance to really build into a significant volume area. So we're just going to be looking at these 4 prices here. So we open at 850 and we move down to 675. Now I mentioned this was a slightly uglier trade because on this first move it is really common. Now we don't like to say the market's going to hold to the tick, right? So markets do need a little bit of leeway in the trade, but it is normal to tag the top of this high volume area before reversing up on the S&P 500. Obviously on a more volatile market like crude, you'll probably see something different, okay? But over and over again on the S&P, you're going to see this again. It's going to come down, trade the top of the high volume area or the tick above, and then reverse. Now, if you wanted to trade that without waiting for confirmation from the order flow, you would need to bid 750 or 775 because a lot of the time it's going to trade into the top of this high volume area, but nowhere near enough to get you a fill. Okay, so if you bid 725, you bid the top of this high volume area, you're going to have a lot of trades where it trades at your price and moves away without filling you. Now in this case, we did get as low as 675, and the market's now ticking up. We're starting to bounce back up, and we've got some decent size traded into the office here at 7 and 725. Now with these trades, you actually have to get in. It's a fast market. You haven't got the bids and offers helping you. You're going to have to get in with limited confirmation. So we mentioned the market depth won't help. You're also, most of the time, you don't see the market hold with icebergs or absorption that often. So a lot of the time, it's just going to go to your extreme, market orders come in, and then take it in the other direction. So in most cases, I'm not putting in a limit order ahead of time. I'm not waiting for areas of high liquidity to lean on, and I'm just waiting for the market to come to my area and then start to tick back up. Okay? Now in this case, here's where we ended up. We got into the trade because we're at a volume extreme, and the market started to tick up. We therefore expect the market to pop, and if the market doesn't pop, we get out of the trade. So it's simple. but you do have to be very nimble getting in and out. So if you go back and look at the charts for February the 10th, you'll see that we ended up trading 23.10 before going back to test the lows again. So this entry, this setup gives us a bounce. Sometimes there's good follow through and sometimes there isn't. And that's why I personally scale out these trades. So the key is to play that bounce and exit if the market comes back at you. Now, how long has this been going on? Is it just a passing fad? Well, this is an example from August 2015. Now, again, this trade isn't exclusive for times that aren't volatile, but I don't have that many screenshots lying about. So this is summertime. So again, we know that this is actually a slow time because it's summertime. So despite the fact we had low volume into the open, we got 67,000 contracts below average for the time of day. We do have an area of high volume from 93.50 to 94.25. It's quite pronounced, so the probabilities are higher. It did taper off a bit at the top, but we can also see higher volume from 95.75 to 96.25. Now, I'm marking this out based on experience. Now, I do this every day, and in August, I just felt that for August, for the slow time, for the way the markets are open, it was worth marking this area off. It's probably a little less significant than it needs to be, but again, it's just an experience thing. The more of these opens you watch, if you're watching it every day, you kind of get a feel for how much volume is significant. And what we can see, we're trading there 96.25 just before the open, and we can see that's where we opened, just at the high volume node. So as I mentioned earlier, sometimes you'll be right, but you don't make any money. So we opened at 96.25, we moved down from that extreme, but you'd have had to be extremely fast and extremely brave to have shorted that move down from the open. So trading early is one thing, but trading 2 seconds after the open is another thing entirely. So again, you will see that over and over again. I've not found a way to exploit it, but maybe you will. But the bottom line, market's going to move very fast in the first few seconds, and that is outside of my comfort zone. So while we do have the setup here, working from a theoretical perspective, from a practical perspective, that is too fast to trade. Now, in the end, we moved down to 94.50. Now, if you look at the volume here, traded at 94.50, you see that 85 contracts traded. Now, if you look over here, that shows us what traded last time round, you can see that 4 contracts traded. So the 4 is what traded last time round. So what that's showing us is that we hit 94.50 a couple of times. Now, I didn't take this trade on the first hit, but I saw it go down to 94.50, bounce up a few ticks, move down again to test it. Nobody wanted to trade it second time round, and that's when I hit into the market. And that was about 30 seconds after the open. Now, there's no reason you have to do that the way I do it. You could have rested an order at 94.75 with a limit order. As I said, your chances of being filled at 94.50 because it's the top of the high volume area are very, very low. So it'll often hit it, but you're not going to get a fill. So we've got an entry signal at 94.50. We've got in at 94.75. We're already past our 4-tick first scale. If you look at the image on the right, you can see we actually got 15 ticks up to 97.75. Didn't turn into a runner. Market moved back down. And what happened is that it tested the low of the high volume area. Now, this is where you kind of have to consider these volume areas purely from the perspective of the extremes of the volume areas are going to be reaction points, and that is it. It does not matter which direction you hit these extremes from. Okay, that's my experience. So I was a little bit nervous, more nervous about taking a trade here because, we had already tested this high volume zone once from the top. But we can see that as we move down, we've got 2,228 contracts traded into 93.75, and again, on a couple of attempts, nobody wanted to trade 93.50. Okay, so after the couple of attempts, 93.50, market started to lift. I just hit into it. Okay, what we can see in this case, the market actually just moved up to 96, but I didn't get a fill at 96. First target's usually at 95. Again, it's not really that important where the market eventually got to on any of these trades, because the key is basically getting into the market at the reaction point, seeing a little bit of a reaction there, getting into the market, taking what you can from it, and aggressively cutting any moves against you. Now, none of that is rocket science, but it's certainly a skill. So if you go away and try this tomorrow, whatever, you will probably suck, but you will get better at it. So just to clarify the rules, volume builds before the US Open in many markets. The more volume you get in those areas, the better. The more you have more positions, more liquidity. You play off the extremes of those high volume areas from either side because they're simply reaction points, points where we get a bounce. That bounce may or may not follow through. So don't expect the liquidity, bids and offers, to be visible as limit orders on the dome. It's really all about the flow of orders and people just coming into the market when we get to that point. Your entries can be refined with order flow, which most of the time is going to show in a lack of willing to trade at a price. Okay? So what you're seeing a lot of the time is a relative absence of order flow, and then the market's going to lift, and then you're going to have to get into it. Okay? Now sometimes limit orders do hold the market. So sometimes, yes, you trade up or trade down. Maybe you trade down and the bidders hold the market and it stays there for a few minutes. But to me, that's the exception more than the rule on the market I trade. Most of the time, just goes to a price. Nobody wants to trade it. Might come back a second time. Nobody wants to trade it again. And that's pretty much all the confirmation you're going to get. Now, the closer you are to an area of high volume just before the open, the better. Because that also means it's going to happen faster, and you might actually need to take it second time round. So sometimes it's going to literally open on the edge of high volume, stay there for 1 second and move away. Then it's going to come back, and that's a better trade because it's not so fast, you've got time to make a decision. Now as you move further from the higher volume areas, the chances of the people positioned there still being in the market are much lower. So if you're 15 points away from a high volume area and you come back to it, this trade's really not on anymore because the chance of the short-term traders positioned there still being there after a 15-point move against them are actually pretty slim. Now the smaller the range of price in the high volume area, the better. Those areas are more obvious, the steps are more pronounced, so there's no ambiguity about where the boundaries are, and your stop out point is closer. Now also what I would be aware of is that you wouldn't be the only person trading this. Okay, this is working precisely because those areas are well defined. So the trades where you've got a chunk of volume and around it there's very little volume are very well defined. Other traders can see that. This isn't working because I'm trading it and nobody else is. This is working because other people are doing it. Right? So the more obvious the area is, the better it's going to work. Okay? When you've got an area that just tapers away at each side, it's a lot less obvious where the area is. You're going to have a bigger stop, and people might just decide not to play it because it's not so clear. Now, there's no need for you to jump on the S&P 500 because that's what you saw here. There's lots of markets to trade. There's energy, agriculture, interest rates, metals. You could well find a market to trade this that's better than the S&P, but there are some markets that are a no-go. So if you look at the Eurex futures, they really do close. There's no overnight volume with them for those European traders. There is a small pre-market on some of the Eurex futures, but it's not significant enough to make a difference. So ideally, US markets that open during the Asian and European session are your target. What you're going to have to do is get to know your market and when you should or shouldn't trade it, what sort of volume is appropriate. Then you have to figure out your trade management. So all in, all out for a small target isn't a bad approach, but I scale out of the trade, and mostly that's because you really don't know what these trades are going to give you, what kind of a bounce. Sometimes it's a 3-tick bounce that you can't make any profit on. Sometimes you get it's a major turn. So your chosen method of whether you scale in, scale out is going to impact which trades you take. So, if the other side of high volume is 7 ticks from your entry point, if you're getting out at 4 ticks, it's really not going to make a lot of sense because, you probably need the 7 or 8 tick stop on that. Now, it would be a good time to start typing in questions. This one is self-explanatory. The key skill with this trade is actually getting out of the trade quickly when the trade isn't working out. So if you're the kind of trader that likes to hold trades just in case, or you like a deer in the headlight, then you're not gonna do well with this trade. So if you can cut trades without emotion when it's not working, then this is worth a try. Now I would also say, in terms of statistics on the S&P, you're going to get about 20% of the trades that you enter will move against you immediately without any chance of profiting. Okay, so I've already said you're going to see this on most days. You're going to have about 20% moving against you. Now, from the remaining trades, the higher your win rate on this, probably the less money you're going to make. Okay, so let me just explain that. So to get a really high win rate with this, you need to aggressively cut trades when they start moving against you, which means you're going to be getting out some potential winners earlier. Okay, so if you're more aggressive cutting the losers, you're actually going to be cutting some winners when you cut those losers. So I shouldn't say that's going to affect your overall profit more. So your win rate is really not something you should obsess over on this trade. Okay, you really need to manage the trade as you feel comfortable. So if you are very aggressive cutting trades, then of course you're going to have a higher win rate. Okay, that might not translate into more profitability. Okay, if you can let these trades, give these trades a little bit of time to work out, not a lot of time, but don't cut your trades every day. Okay, if you give it a couple of ticks leeway, don't go for a break-even stop. The moment it's moved 2 ticks. So that's one of the things you need to kind of figure out as you observe the behavior, because your win rate and your profitability are related, but if you focus too much on the win rate, you're going to find you're cutting too many trades that will work out well, and that was certainly my experience. So Terry, with that, we're really done. That's all the information I've got to share.
Okay.
So if we've got any questions, we can go through those now.
Okay, let me pull the questions up. Okay, let's see. You've mentioned confirmation a few times. What do you consider what are you actually looking at on the DOM for confirmation?
Okay, well, it's mostly the movement on the DOM. So one of the things about the S&P 500, there's a lot of people that call it the second chance market. So on the S&P, if you get in, even when it's a losing trade, it tends to come back to your price and tease you a little bit. So one of the things about the S&P specifically is I kind of rely on the fact that it tends to go back to a price. So like I say, the bids and offers will not be significant. You will sometimes get an iceberg order where you move down to a price, trade a lot of volume, the bidders step up and absorb the selling, and then you move away. Most of the time on the S&P specifically, I want to see it go to the extreme, move up a couple of ticks, go back to the extreme, see nobody trade it, see just like 10, 20, a handful of contracts trade, and then see the market lift up. And it's when the market lifts up away from that area that you've got your opportunity. And that doesn't mean you have to be fast. It doesn't mean you have to be terribly fast because it's the S&P. But it's effectively, it's just the market lifting up. So a lot of the things we use for confirmation later on in the day just aren't really there for us at this point in time. And you'll see this if you watch it. You'll just see it. It's perfectly fine. It's just a different time of day, just working a slightly different way, and you just have to take a different amount of confirmation.
Okay. Can I implement this mindset in individual stocks?
To be honest, I don't know, because this isn't something that I've looked at in many markets, so I'm kind of lazy. This is something that I basically saw this because I'm sitting there at the open every day anyway, and it was just very interesting volume profile as a trader. So I take a lot of trades off the volume profile. So I was just sitting there watching it, and I just noticed that the volume before the open was causing a reaction after the open. So I think what you have to do is watch the individual stocks and see what's happening. The problem with stocks is that the pre-market action can be quite light. You tend to get more pre-market action on stocks that have got earning announcements for that day and stocks that have, you know, big news. So what I would do, I would say that if there's no major news or it's not a major stock, there's not going to be enough overnight trade or not enough pre-market trade to really make a difference. But I would say for new stocks, stuff like that, yeah, that is definitely a chance that you'd see this there.
Okay. You were showing a few charts. Do you use them in conjunction with the dome? Also, what charting software do you use?
That was NinjaTrader plus the Jigsaw tools. The reason I have the charts there, it's mostly for trading I do later in the day, not so much for this trade. So, you know, like I said, I have the heat map up there, but I don't really use the heat map for this trade. I'm really trading mostly on the volume profile. Now, saying that, if the Dow and the Nasdaq are really moving up quickly, and I'm due to take a short trade, then I'm not going to take the trade. If we've got real strength in the market on, you know, the other indices, I'm not going to short the S&P. But mostly I'm just using the volume profile and using the Ninja charts.
Okay. Are most of your orders at market or on stops or limits?
Mostly on market. There was an exception in those slides where, you know, we'd gone up to the top of the high volume node. The market started to try and tick back down, but the bidders were holding it, and we traded like 2,000 contracts into the bids. And I put a volume stop there because I figured, you know, I don't want to go into market yet because it hasn't broken. And if I do go in when it breaks, I'll probably slip because people are going to start to stop out. So I put a volume. I still slip to tick, but I use a volume stop, which is effectively a type of market order. But most of the time, I'm putting in market orders. There are exceptions. You know, if the market's really, really slow, I might put a limit order in one tick above the zone because I figure, you know, it's probably going to hold anyway. You know, if the market's the Dow and the Nasdaq are flat, it comes to the area, there's not really a lot of, you know, trade anywhere. I can put a limit order then, but most of the time I want to see it lift, and so I'm more comfortable to put a market order. Now, that's not something I do the rest of the day. So for the rest of the day, I'm mostly getting my limit orders, but for this trade specifically, I tend to be more market order than anything else.
Let's see. Do you use LVA and HVA and point of control like a market profile trader might as reference points from the previous day?
I haven't. For this trade, I just purely use the overnight volume. I don't know if it coincides at all with any previous volume from the previous day. Could be that it does, and it could be that there's additional edge there. But from my observation, I'm just looking at the volume from overnight.
Okay. Concentrating on behavior, are we talking about watching the open after signaling high volume areas and watching the price come back there, showing no interest in being traded, and then deciding to get in? Yeah,
pretty much. Basically, you're going to see, and you'll see different things on different markets, but yeah, it's the volume into the open that you're interested in. It's the volume that's close to you that you're interested in. And, you know, the key really, sometimes it'll be a lack of interest. Sometimes you'll just get at the market lift you'll just see like some big size come in, the market start to lift. So it's really the lift away from the area that's most important. It's just on the S&P. The S&P itself tends to come back a second time, which is why it kind of applies there. If you look at crude, you'd probably most likely on crude you're not going to get that at all, that second chance. Crude doesn't work like that.
Okay. What about using this idea to close?
Well, that's the other thing, because that's a really good suggestion, because I often thought, why don't I trade from the open to the high volume node, and the high volume area could be my close. And it's just something I've never looked into, but basically because, you know, you're looking at it from a behavior perspective, you know, you're seeing the market open. So you might, for instance, find that the market opens 8 ticks away from a high volume area, you can actually play into the high volume area. It's just not something I've done. But if you're looking at it from a behavior perspective, you've obviously got more of an open mind about what you're actually going to do with these moves that occur on most days.
Okay. I think that was most of the questions. Have you looked at this on other markets, such as crude or gold?
No, I'm completely lazy as a trader. I really only trade the S&P, and I watch it going into the open. Now it's one of the things that has occurred to me is because the markets have different open times. You've got the crude open, you've got the treasuries opens at 8:30, crude open at 9, the indices open at 9:30, you've got the grains opening at 10:30. You've got a whole spread of opens in the trading day. So I haven't looked at them just because it's not my focus. I would love to hear if somebody looks at the other markets and how this actually works out there. But no, for now I haven't.
Okay. That's all the questions I see at the moment. Oh, there was a question. We have the copies of your slides. Can we post them on the forum? There's people asking for a copy of the slides.
Yeah, sure. I'll probably send you an update because I added this slide with the stats on.
Okay.
I can send you that update now, and then
absolutely.
we can put that on there. No problem.
Sounds great. The color scheme you had set up on your jigsaw looked really nice and easy on the eyes. Is it easily duplicatable?
It is if you just... It depends if you're on the Rapid Trader or the Jigsaw plugin. Either way, we do have it for you. If you just want to drop me an email, I'll send it to you. Or there's a Q&A thread. There's also a Q&A thread on Futures.io forum. If you ask there, I can then post the files you need in reply.
Okay. Do you let it hit the stop limit if it doesn't work, or just hit the market order to close?
If a trade doesn't work out, I tend to actively manage trades. So for me, it's a mortal sin to let a stop get hit, and because I really want to be able to try and get a good feel. You know, using all these skills to get into a trade, and to me, you should use the same skills to get out. So most of the time, I exit when a trade's not working. I exit with a market order, but I do have a stop there, which is more of a safety stop. It's not a stop limit; it's just a standard stop order. But I have a stop order there because this can run against you quickly. So you'd have the 20% of the trades that are just going to move against you straight away, and I don't want to get caught out when that happens.
Okay. Which version is better, the standalone or the Ninja plugin?
Oh, of Jigsaw.
Yes, of the Jigsaw.
I don't know if I can say it better. I don't think there is a better. It's just different, basically. It's just different. It's actually the same product.
Okay.
It's the same code. So, you know, it's just whatever suits you more.
Okay. What is the average time frame of the trade?
Average time, it depends. I mean, the market's pretty slow right now. You're literally probably average 10 minutes. You know, you're going to have trades that you're out of in 20 seconds. You know, sometimes the losers can be, you know, seconds, right? The trades that work out, it really depends how much volatility is in the market, and also how far out you scale trades, how far out you scale. So I put scales quite far out. So I would say, you know, I have some trades that I'm in for 90 minutes. But I would say if you took an average, I'd say probably 10-15 minutes you'd be in the trade.
Okay. When will the Rapid Trader Pro get heat map?
Monday.
There we go.
It's this Monday, by the way, not Monday in 2 years' time.
That makes me think of a Ronald Reagan Soviet Union joke about waiting for a car for 10 years.
Yeah.
Is there a possibility of swapping the NT version now and swapping it for the standalone version in the future? So I guess if they like change platforms.
You don't really need to swap, because if you are a customer now, when we release the Rapid Trader, you'll get access to it anyway.
Okay. That's all the questions I have at the moment. Okay, yeah, we're at about an hour, so I'll close that with the questions. Thank you for the webinar and the information. As always, it's very helpful and lots of good comments. Lots of people saying thank you. So.
And I would love to hear. Thanks for coming, guys. And I would really like to hear how people get on with this. Like I say, you're better off observing it for a while before you trade it. I would really love to hear your observations.
Absolutely, and you can go onto the forum and you can message Pete directly and let him know how it goes.
Absolutely. So thanks all, and thanks Terry.
You too.